All right, let's go ahead and get started. Good morning, everybody, or good afternoon. It's now lunchtime for everybody. And so I want to welcome everyone to our SoCal CCIM Lunch and Learn. We do this once a month where we get an opportunity to bring some information to our members in the commercial real estate community. And definitely want to thank each of our participants, our panel, for participating in today's event. So we're very excited to bring this information to you today. We do have a couple of slides here that we're going to share, then we're going to go ahead and get into the discussion. And so wanted to share information regarding CCIM. Basically, the mission statement, which the mission of CCIM Institute is to elevate our members to the highest levels of success in the commercial real estate profession. And so, especially during this time of COVID, there's been some additional efficiencies that we've had to reach a broader audience to go ahead and bring some information very timely and very quickly to our members and to the community. And so, again, want to thank everyone for participation and for everyone that has helped to put on our programs. We also want to encourage everyone to follow us on different social media sites. You see there that we have Instagram, Facebook, Twitter, and YouTube. And then on YouTube, you'll be able to see all our past recordings of all the events that we've had of this year. And this event is also being recorded that will be on there as well. So wanted to bring some information regarding November 3rd ballot, which is Proposition 15, the split roll tax. So that's something that is going to be on the ballot. And this could really change the landscape of our industry, especially those properties that are above $3 million. And so we want to make sure that everyone's informed, that they speak out, and really have a really clear understanding as to what this proposition could mean for our commercial real estate industry and naturally for each of our businesses as well. So very important prop that we be mindful of and stay on top of during this time. Also want to give recognition and a big thank you to our board members. There's no way we could do the things that we do without our board members. And so I want to thank them all. Each of them give their time to our CCIM chapter. And so I want to thank everyone because there's no way we could do the things that we do as mentioned. Also want to recognize each of our sponsors. And our sponsors are really the big lifeblood of our chapter. And so, you know, they've given us a lot of trust and confidence. And so we want to make sure that we do what we can to make sure that they are highlighted best as they can. And not just highlighted, but each of them are not only well respected, but are very good at what they do. We've had an opportunity to meet with each of our sponsors and to do business with each of our sponsors. And I can tell you that I do give referrals to each of them, and each of them are very good at what they do. And so we definitely want to support them as they are supporting our chapter. And so with that, we do want to bring in our sponsors to you know, to talk a little bit. And so why don't we start off with Daniel. Daniel.
Hey, good afternoon, everybody. My name is Daniel Munoz. I'm with CDC Small Business Finance. We are a certified development company that specializes in SBA lending. Me in particular, I specialize in the SBA 504 program, you know, doing lending for owner-occupied commercial real estate. We've been around for a little bit over 40 years now, #1 SBA 504 lender in the country. And just want to say thank you, Gary, for including us in today's webinar as well.
Yeah, thank you. Thank you as well. We appreciate everything you do for us. And so let's take it to Kim Tran. Kim? You there, Kim?
Okay, how about now?
Yeah, there you are.
Hey guys, my name is Kim Tran. I'm the electrical representative for CoStar, and with that, we would like to provide state information, listings, data, and advertising. So, there's a lot of changes happening right now within the market. We have real-time, up-to-date information. So, first, let me know. Feel free to reach out to me, or if you have any listings you want to see what kind of listing exposure you're getting, you can reach out to me as well, and we can do an analysis for you. I'll leave my information in the chat if anybody needs to connect. And then, other than that, I hope you have a great meeting.
All right. Well, thank you for all your help and support, Kim. So thank you for everything you do. And so with that, let's take it to Mr. John Baker. John. John, you there?
Uh,
You're on. Go ahead.
all right, sorry, I thought I'd been kicked off. Good morning or good afternoon. This is John Baker. I'm with Baker Law Group, and I'm a real estate attorney. And I've been really busy within the last couple of months with trying to close deals and keep them alive, as well as tenants and landlords wondering what to do. As you may have heard, it appears that starting on September 1st, it may be possible to file unlawful detainers, both commercial and residential. We'll see what happens on August 31st, because that tends to be when the new orders or the extension orders seem to come through. The Judicial Council, which is the rulemaking arm of the California Supreme Court, was going to make it August 1st when you could file unlawful detainers, but when the Judicial Council, in particular the California Supreme Court Justice, was contacted by legislatures and the governor, the Supreme Court and the Judicial Council were persuaded to not end the moratorium quite as quickly and give the legislature time in which to come up with an actual law passed by the elected officials. But that hasn't happened yet. So right now we're looking at September 1 is when we can file unlawful detainers in Orange County. Thanks very much.
That's great information, John. Thank you for that. That's really good. Dino Champagne.
Hi, everyone. Hope everybody's staying cool. 1031 tax deferred exchanges. We've been very, very busy. I would say that to bring up to everybody's attention right now with the inventory market that's going on, getting a lot of requests for reverse exchanges. People want to secure that replacement property before their sale has actually closed. Just sort of watch out on when you have a situation like that you're looping in the qualified intermediary before you're getting too far down the road with contracts. It's an expensive process. It's a complicated process. And then sometimes there's issues with lending that could impact the transaction. So when you're out there working with clients that want to, lock up that replacement property, if you can get them to extend the closing of the purchase until after the sale closes, that's perfect. In the event that that's not the case, again, bring in the qualified intermediary early on to discuss the reverse exchange. If there's a lender, there's going to be documentation that the lender has to approve. So you don't want to get yourself caught in the crosshairs in the event that you can't get the reverse done and you're locked into a specific closing date. Dino Champagne, asset preservation. Just as another note, we're out there fighting to make sure our 1031s will stay in place. So we're very active on that front. So with that being said, everybody stay cool.
Dino, thank you so much. And Earl, I know you're a panelist here, but would you like to say something real quickly?
Hello, everybody. Earl McCoubry, loan officer at Fidelity Bancorp Funding. And so commercial real estate loans on investment properties and owner-occupied properties, as well as bridge loans. So there's several programs over there for use by commercial brokers and by investors and property owners. And so we'll be talking more about that later on from the panel. Okay, thanks very much.
Wonderful, thank you so much. And so we do have a couple of sponsors here that are missing today, and just want to give them a little plug. Starting off with AIR CRE, Sean Pullen. Sean's been a wonderful resource for us, along with AIR. Their platform is fantastic to find properties and find tenants. They do have an agreement with Prospect Now where you could definitely pull some information that may be helpful to get some tenant information. Along with Coast to Coast Escrow, Mr. Kip Kennedy and Brenda Burnett, they're fantastic at what they do. They've done a lot of escrows for myself, and they've been really top notch, and I've never had any issues, and they make me look really good. Along with Ken at Platinum Wealth Group, DSTs, and so we've certainly sent over some clients that were not so much interested in owning property per se, but wanted to own some type of property interest, and then Ken's been able to help some of my clients and place their property, or at least their funds, in a property where they're at least getting some cash flow off of properties. And so, again, wanted to thank our sponsors. Thank you so much for everything you do. We really appreciate your trust and your confidence with us, and for all of the attendees that are a part of today's webinar, just want to encourage you, if you have any questions, all our sponsors are open for business and want to encourage you to talk to them if you have any questions. So again, sponsors, thank you so much for all your help and support, and yeah, thank you for everything you do. All right.
Thank you, Gary.
Thank you. All right, so with that, let's go ahead and get into our program. And so we have our panelists here, Earl McCoubrey, Greg Dill, and Daniel Munoz. And so today's program is we want to make it as interactive as we possibly can for all the participants that are on the line. And so you will see a Q&A box there that if you have any particular questions, you could go ahead and type in your questions right there, and we will make sure that each of them get answered before we sign off here. If you do have a question where you actually want to say something live, go ahead and raise your hand, and we'll go ahead and unmute you so you could go ahead and say your question live as well. And so I had an opportunity to, or the privilege, I should say, to work with each of our panelists here, and I can tell you that each of them have been tremendous as far as working with. My clients have been very happy, and I have no problems with any of them, and I'm very excited and thankful that not only they're part of the panel, but part of our chapter and part of my commercial real estate career, because they certainly make my job much easier, because each of them are real strong professionals at what they do. And so I'm gonna go ahead and allow each of them and introduce themselves, of who they are, what they do. And so why don't we start off with Earl McCoubrey. Earl?
Okay, thanks very much. Can you hear me okay?
Great.
Okay, really good. So Earl McCoubrey from Fidelity Bancorp Funding, and we are a commercial real estate mortgage brokerage in Santa Ana. Serve the whole country from there, but I keep my practice pretty much in Southern California. So we offer institutional rate mortgages on apartment buildings, both refinances and purchases, as well as business properties, so a lot of industrial properties and warehouses, as well as office buildings. Retail is a little bit tough to do right now, but sometimes we're able to do those. So pretty much commercial properties. And so we work a lot with investors, as well as sometimes also business owners. And so that's what we look for. So we have the institutional rate program, which is where most of our work is. We also have an in-house bridge loan program. So whenever a property is not ready for its long-term financing yet, or perhaps the borrower is not ready yet, why we can do an interest-only bridge loan for a year until things, for a year or two until things are ready, and then we convert that to a long-term loan. And so we have several programs of interest to property owners and investors. Okay, thanks very much.
All right, Mr. Greg Dill. Greg.
All right, am I on mute? Can you guys hear me now?
Yeah, we hear you. Go ahead.
All right, I think I was turning off mute and you were turning it on, and vice versa. So good afternoon, everyone. I'm Greg Dill, SBA lender. I focus on financing owner-occupied commercial real estate typically for business owners, small business owners. I work both in the SBA space as well as the conventional space. So SBA, obviously, I think a lot of people know about that low down payment program, long-term financing. Clients can get in with as little as 10% down. And then on the conventional side, for the owner users, that's typically a 25% down on that. So I do focus in the Southern California region with my bank platform. It's all of the West Coast, so California, Oregon, Washington. I can also finance in Nevada, Arizona, and Texas. And I'm a licensed real estate broker in the state of California. So my claim to fame is if I can't do it where I'm at, I'm gonna at least put you in contact with someone who can, no matter where it is in the country. I do what's called a full field underwrite. And so before it goes into underwriting, I've already done all of the cash flow, all of the modeling, have a perfect package to submit either to my shop or somewhere else. So I'm going to give you, my favorite answer is yes. The second's a quick no. And if it's a no, I'm going to send you on your way to someone else that can help out. So once again, I'm Greg Dill, the SBA lender.
Greg, okay, all right, thank you so much. And so Daniel Munoz, Daniel.
Hey, good afternoon, everybody. Thank you, Gary, for the introduction. My name is Daniel Munoz with CDC Small Business Finance. If you're unfamiliar with what a CDC is, we're a certified development company, a nonprofit organization, and our goal is to help bring loans to small businesses. I mean, we've been around since 1978. We have completed over 12,000 loans to small businesses, and our goal is really to create for job creation and to assist small businesses in their growth. You know, over our span, we've created about 209,000 jobs, and we've done about $20.8 billion in lending to give small business owners access to capital. As a nonprofit organization, we work directly with the SBA. We work as a liaison to bridge that gap between the bank and the SBA. You know, we do have our core values, and we want to make sure that we pass those along to any of our borrowers and any of our third-party lenders that we are working with. You know, integrity, teamwork, commitment, and we definitely want to make a difference in our communities that we serve, which is the California, Arizona, and Nevada market. So thanks, Gary.
Well, thank you for being here as well, and I truly appreciate all the support you give our chapter. And so, well, we think this panel is very timely because naturally, when we're dealing with COVID, I mean, these are unprecedented times, not only for business, but for lending and for real estate and for, for every, our entire world. And so, I mean, there's still a lot of opportunities that are out there that buyers are interested in purchasing properties. There seems to be a lot of cash that's out there, a lot of interest, a lot of buyers looking for, the good deal, right? And so, as commercial real estate professionals, and I'm looking at our attendees here, we do have a good portion of our attendees that are in the lending field along with that are commercial real estate brokers. And so what we want to do is give them as much information as we can to be best equipped. So when they're out there talking to their clients and, and finding opportunities for themselves, and we want to be able to give them information so they can be the best resource they possibly can be to their clients. And so as we're talking about lending here, any nuggets that each of you have, any additional information that would be good for us to know, especially the commercial real estate brokers, that don't know a whole lot about lending. We're really going to rely on you and hope that you give us some good information here. But why don't we start off? And Greg, why don't we start off with you? Just in general, I mean, what are we seeing in the landscaping here for for lending and for financing at this time?
Well, definitely due to the coronavirus, the COVID aspect that we have right now, there's a lot of lenders that have really pulled back on the reins. So some lenders completely got out of the game. They said we're going to wait through this. Other lenders may have stopped certain things. For example, we're a little bearish on transactions that involve tenant improvements or major tenant improvements. And I know a lot of lenders completely shut that down. We're on a case-by-case basis, which makes sense. I've been working with clients for months now, 6 months, one for a year that wasn't able to get their permits, and now it's even more difficulty. So that comes into play, especially when we're doing on the SBA 504 side where we have a bridge loan. So I think in general, the landscape with underwriting, I'm having a lot more questions from underwriters, and I'm obviously trying to nip those in the bud ahead of time. The other thing is with the government aid that was provided either through the PPP program or the EIDL program, we need to get really scrutinize those. So we're going to have payroll numbers. We're going to have to see if those are going to be converted into grants. And then on the ones that aren't, we are going to have to consider them and debt service them and cash flow. So when someone says, hey, I got this loan, and if it's a $30,000 loan, fine, but some people are in the millions. So when you're cash flowing that's going to do a detriment on your debt service coverage and how it's going to affect you being able to acquire a building or acquire another business.
Great. How about you, Daniel? What are you seeing out there in your world, CDC world?
Like Greg, I mean, we work with a lot of different lenders out there for, when we accomplish a 504 loan. We are extremely busy still. I mean, across the board for us, we We have been seeing a lot of different 504 loans come across our desk and different projects come across our desk. We do feel it though. I mean, like Greg was saying, just to piggyback off of that, is the fact of these PPP loans and these idle loans that went out, and a lot of financial institutions are out there, and we really don't know what's going to happen, and so we have to take that into account when we're debt servicing these loans and when we are looking at an overall file. But at the same time, there is lending going on. There is still projects going on. It's definitely going to be a case-by-case basis, but I think the biggest thing for us right now is to make sure that borrower and lender as well are fully transparent with the file. It's a very big thing right now, especially in trying to get SBA funding. That transparency is the key. We want to know how they're going to weather this storm in regards to the pandemic, and we want to know exactly how they've been doing during this time and what they plan for after, once everything kind of clears up and goes on its way.
Yeah, the PPP and idle are certain questions I want to come back to, but before I do, Earl, you are a loan broker. What's happening in your world? What are you seeing?
Yeah, we're a brokerage. There's about 28 of us loan originators there at Fidelity. So all of us are deep within a whole bunch of deals we're all doing. So we work with an awful lot of different lenders, both bank and non-bank lenders. And just like Greg and Daniel said, there's lenders who have just stepped back completely and says, we're not lending right now, so call us back after the pandemic, whenever that is. Others do continue to lend. However, the restrictions are gargantuan, just really big restrictions and reductions in loan values, and pardon me, the requirements are being far stiffer and everything. On the other hand, there's also a group of lenders who realize all this, and so they realize there's an awful lot of pretty decent deals out there not getting financed. And so there's a group of banks and non-bank lenders who are out there to go and cherry pick among deals out there that nobody else wants to do. They're really good, make sense deals. So sort of our role in the marketplace is to know among a lot of different banks and non-bank lenders out there, who's lending, who isn't, and among those who are lending, how are they doing it, and what are their criteria, what are their requirements, and because every deal is so different. So what I'm finding here, as far as the mood is concerned, uncertainty is probably the biggest factor right now. The fact that nobody really knows what the future is going to be like, the immediate or the long-term future is going to be like in terms of what the market is going to do, or in terms of regulation out of Washington, D.C. and out of Sacramento. And so just the uncertainty and trying to navigate through clouds in the middle of the night when you really don't know what's up ahead is tough for lender policymakers and underwriters to deal with. So they're doing their best, and overall, we're still getting things done. Another thing is cash. Cash is really king. In apartments, we saw an awful lot of lenders who are saying, okay, so here's the loan, but now we need for you to have 12 payments, principal and interest in payments in the bank on the date of closing, or perhaps 10% of your entire loan portfolio debt, in a bank account. So if somebody has a bunch of properties and maybe they have $60 million in mortgages altogether. Well, some lenders want them to have $6 million in cash and sitting in the bank for in the event that liquidity is needed in order to keep their payments up. Well, you know what? There's an awful lot of property owners out there who are not that liquid, and so there's an awful lot of deals being declined because of liquidity. Loan to values are lower on a lot of different kinds of properties from a lot of lenders. Not all of them, but just many. And so everybody's just trying to work their way through this as best they can. We try to add value by taking a particular situation and figuring out who the best lender is here for this particular combination of property, cash flows, borrower strength, borrower liquidity, credit, so on and so forth. And I'll tell you, it's tricky. We have to work about 3 times as hard as what we've had to do before. Still, though, there's a lot of investors out there who are looking to buy properties. There's still a lot of people out there ready to take a risk in this economy and buy properties and move their businesses forward and so on and so forth. Very heartening. So
Good.
let me be quiet a little bit. Listen to somebody else.
No, that's all really good information. You know, but I
was gonna say I always like it when the banks say, yeah, I'll lend you $1 million, but you have to have $1 million in deposits. Yeah.
Yeah, we're kind of working our way through that on 2 or 3 things right now, as a matter of fact.
Yeah, it's like I always say, the banks are always willing to lend you money when you don't need it. It's something that comes up every once in a while. But okay, so Greg and Daniel, you talked about PPP and IDO. Okay, so so if we have a client that's actively looking to purchase a property, let's say it's an owner user deal, and they found a property, they're ready to submit all their paperwork for financing, and they're ready to jump into escrow. And then you know that they took out a PPP and or IDO loan. How are banks looking at that? Is that going to make it automatically challenging, or how does all that come into play for a buyer?
Well, I'd say not necessarily challenging, but we're definitely going to be looking at, say, with the PPP loans, those are the loans that are, the plan is to have as much or all of it converted into a grant. So there's some of the banks have actually opened up their portals to allow for this to happen. But if not, and if it hasn't started, we're going to really look at to make sure that they have kept their employees, because that's the biggest portion for them to keep their employees within the certain time frame and when they got it to be able to convert. So that's one thing. On the EIDL, we're just going to look at it and see what's their monthly payment going to be. So it's going to be part of the debt service. Some people have actually taken the EIDL and then returned it, so then that obviously isn't going to matter. But we are definitely going to look at that. It's going to be shown on their balance sheet, and then some of it's going to be shown on their income. One thing to note, because I've come across this a number of times with clients, with the PPP, it's essentially an other income for the year. So we're not going to be able to count that as part of their normal cash flow. So whenever we see other income, a lot of times when we're looking on someone's P&L, we're going to see other income, and a lot of it's going to be someone pays it with a bunch of credit cards and they actually have cash back rewards. Well, we're not going to count that as part of their cash flow. That's going to always be taken out of their bottom line. So even though people are getting this money for the PPP, we want to make sure that it's not looked at as actually part of the cash flow and part of the actual income from operations. So those are how we're going to be looking at that, and we're going to ask for their 940 and their 941, so we can make sure what their payroll was for the first 2 quarters plus any time after that when they receive their financing.
Yeah, Daniel, that's you have anything to add to that?
No, I mean, Greg's pretty spot on. I know for us in regards to what we're doing on underwriting these 504 loans, is the idle. I mean, we can look at right away, and we can add that into their cash flow right away, to debt service, because it's already a loan. It's not going to end up turning into a grant or anything like that. So that's something that we can actually accomplish up front. The PPP is just a little bit more to navigate. We look at it. Yes, we do throw it into cash flow numbers, but it's not necessarily hurting them, because essentially we have no clue if they're going to be forgiven or not on that basis. We will ask and see if they received a PPP loan, what the dollar amount was. And at the same time, we look at job preservation as well. We are going to look into these, but it doesn't necessarily kill a deal. It won't necessarily mean that, sorry, just because you received a PPP loan and yes, it is guaranteed by the SBA, it's not going to hurt their deal moving forward with the SBA.
So you guys talked about cash flow, and from an underwriting guideline, from what I understand, there's typically like a cash flow ratio or debt coverage ratio, that all lenders use when they are spreading the numbers. What are cash flow ratios? I mean, what were they pre-COVID, and have they changed today? Earl? Daniel, anybody?
I mean, cash flow coverage for us essentially stayed the same. Our underwriting guidelines didn't change too much in regards to the cash flows perspective of it, but also we're a lot different when it comes to underwriting loans compared to a third party lender. We didn't have to make certain adjustments. So we do look at the overall transaction, not just what the debt service coverage is actually going to end up being. If necessary, we will add in projections for the next 12 to 24 months, depending on the type of situation, type of transaction. But cash flow coverages for us are a lot different. But whenever we underwrite, we still take into account what the cash flow coverage for an approval on a third party lender is. It's kind of tough to give kind of a number because all lenders that are out there that we work with are going to have such different policy changes when it comes to credit underwriting. I know, just speaking from bank experience from before, typical SBA lending was going to end up being that 1.15 debt service coverage to 1.25 and above, for a year or two historical financials, which it may increase, it may have not. It just really depends on that lender. But for us at the CDC, it really hasn't changed too much.
How about you, Greg?
Yeah, so I think there's two ways of looking at it. One, on the SBA side, there's specific guidelines that they have to follow. So those are usually minimum debt service coverage requirements, which, like Daniel mentioned, is 1.15. That might be more so for the SBA 7A product. What Daniel also mentioned was projection-based financing. So in general, on the CDC side, because they're more looking at is this thing eligible? They're allowed to use projections, whereas most big banks aren't going to use projections. So you might be dealing with a non-bank lender that's going to be able to take something that's a little bit more highly risk rated. So usually what happens is with debt service coverage ratios, maybe on the conventional side, and then as well as what a first trust deed on the 504 is technically considered conventional for a bank, they're going to usually higher than what that's going to be needed in the SBA realm, which I think Daniel mentioned the 1.25 upper level. So I'll usually will see that 1.25 to 1.35. I don't think anything, at least on my side, of any strict policy changes. Usually policy changes don't happen with something like this, or even a decrease with some type of recession. What happens is it's sort of the tribal rules might change. So they're going to look at something, they're going to hit it a little harder, or do a little bit more stress testing. And so whereas maybe we still remain at that 1.15 or 1.25, now they're saying, well, let's see what happens if after 5 years your rate goes up, and we're going to underwrite based on what another 2%. So I think that's what we really have to look for. And it's when anyone ever asks me, well, what's your debt service coverage ratio? I can tell them, but every bank, every SBA lender, every CDC, they're going to look at it in a different manner. So it's hard to say. What I always tell people is, especially on the commercial real estate broker side, is ask their clients, do they want to put 10% down and go the SBA route, or do they have 25% down plus money for their liquidity, money for their personal as well? And then the other rule of thumb that I always use is roughly for every $1 million in financing, it's about like $5,000 to $6,000 in monthly mortgage payment. So that's a good thing when someone says, hey, I'm going to buy a $1.2 million building and I have 200,000. Well, they're probably going to pay around 5,500 or so monthly on their principal and interest. So that's a good rule of thumb for you commercial real estate brokers to use when you are touring clients and they ask, hey, what would my payment be?
And so each of you mentioned that, I mean, it almost kind of depends, right, as to, probably a lot of factors are down. And I would assume that some of that really depends on the industry of what the borrower is currently in. Are industries important right now? So as an example, say like a e-commerce distribution type company, say, versus a restaurant building or a chiropractor or a dentist. I mean, are there certain banks that are just absolutely no to those, or is there what I guess what are there differences in the different businesses that are looking for financing? Daniel?
Yeah, there is. It's definitely the pandemic has changed everything, right? And in the way that lenders are looking at things. I know for us specifically, we've kind of just come up with our own industry risk matrix internally just to be able to kind of see exactly, you know, what industries are actually being successful right now during this time, which ones are taking a hit. I mean, I think definitely it's once we look at it, industry risk is a huge thing for us, in being able to navigate through our underwriting process. You know, with industries that we see now in doing lending, we're still seeing it, you know, various industries across the board, from construction, residential construction, to you know, doctors and dentists in the medical field, doing deals for that. You know, I can say for sure that e-commerce, you know, we've been seeing a lot of different leads come through for e-commerce distribution centers, and with people just not being able to go to a typical brick and mortar, people are just shopping online a lot more than they have been before, just because of the access to it. But overall, I mean, we have been seeing it a lot. Manufacturers are still looking into expanding. It just really depends, you know, on the industry itself and on the business itself, to see exactly what the type of transaction that we're going to try and complete, and to see what risk rating that we put on when we underwrite.
Right. Greg?
Yeah, I mean, I think as far as industries, you know, all of us can probably think of it right now. It's probably going to be pretty tough financing a restaurant, right? It's going to be pretty tough financing an event planner. Maybe even some in the office industry. I've working with some doctors, and if they're primary care doctors, that's one thing, or doctors that are essential type. But then if you're a plastic surgeon, esthetician, these type are very hard to get the financing for right now, because we're going to be looking at what they've done within their interim, which would be the last 7 months. So January through July, they may not be cash flowing there. So is this going to change? Yes, it's probably going to change, but definitely lenders are looking at this a little bit with a little bit more scrutiny. So those are, I think we can all think of the industries right now that are hurting, and those are obviously going to be the toughest industries to get the financing on.
And Earl, from an investment standpoint, if an investor is looking to go buy, say, a multi-tenant industrial park or a multi-tenant office building and retail building, I mean, all of them are each very different in classes. How are lenders looking at those investments at this time?
The really big thing is how well are they going to be able to weather the rest of the economic cycle. So we have to go down the lease summary and actually get all the leases, and actually figure out for each tenant what's the likelihood that the tenant is going to be able to continue to lease and pay their lease payment okay. So we have to go one by one. Sometimes we have to collect tenant financials for that. You know, sometimes though you get tenants who are like great big giant names, and so you say, well, they've got enough money, don't worry about it. So Starbucks would be a really great example of that. You know, we got Starbucks here in this unit, so they're rich. We don't have to worry about them being able to make the payments. No, but the way their lease is set up, though, they're able to get out of that lease. And so you could wake up one morning and find your Starbucks tenant is gone because there's a provision that allowed them to terminate early. So we have to spend more time in showing an underwriter why it is that the cash flows will continue to come in on this property. The other aspect of it is that when an investor is really, really low on cash, they have very, very little liquidity, and when their history shows that habitually they don't carry a lot of liquidity, a lot of cash in their accounts, that's a problem. On the other hand, for people who have a couple $1 million and invested with a brokerage, Charles Schwab or something like that, it's not a 401k or something like that, but it's just an investment account, that's a huge positive. So it's one of the really big things to come out of this whole cycle, the big lessons for investors is, first of all, husband cash. That is, keep a lot of cash, be liquid. And another one is to keep loan to values low. And another one is to keep on the lease summary, make sure that there's 3 to 5 years remaining on all the leases. because when you start getting less than 3 years remaining on leases, a lot of underwriters will just say, well, we're not going to count that rent at all because we don't know if that tenant's going to stay or not, even if they have lease options. Sometimes they'll say, well, we don't know if they're going to exercise or not. We just don't know. And so uncertainty. But if an investor has a lot of cash and a lender might say, you know something, out of this entire lease summary here, you've got 50% of the tenants who have less than 3 years to run on their lease. So we don't know if they're going to continue or not. But on the other hand, the loan amount is $2.5 million, and your investor client has $2 million in liquidity. So I think we find a way to do this. We might put some of that cash into an account here at our bank. We might make them do that. And I come back and say, well, but how much interest are you paying on that? Well, we're paying less than 1 point. Boo hiss. How about if we have investment grade securities and we use those as collateral at the bank? And sometimes the bank will say okay to that, in which case they get to have a higher rate of return and all the benefits there are with capital, with price appreciation, as well as dividends or whatever might be coming from those securities. So we sort of have to work with them a bit. But you know, overall borrower strength and experience and net worth being really a big number, as well as liquidity. Those are the kinds of things that we should be talking with our investor clients about, as compared with those investors who are trying to get by in a shoestring. It's really tough to get those approved.
Wonderful.
Also, on the schedule of real estate is another good thing to show, and that is when somebody has a schedule of real estate, they have a number of properties on there, you know, paid for free and clear. That's a big help. That really impresses underwriters a lot. It's that's another really helpful thing. So managing the overall financial picture of an investor is very helpful.
Wonderful. That's helpful. And I'm thinking about, the properties that are multi-tenant where there is no anchor tenant, but there's a lot of, smaller tenants, say like a retail center or, where they're at 1,000, 1,500 square feet, everything's pretty small. Usually those types of tenants sign, shorter term leases, so it sounds as if they don't have 2 years left in their lease, then, and if a good portion of those tenants they have a lot of lease expirations coming up within the next 2 years, a buyer is going to have a very challenging time finding financing unless they have a lot of cash in the bank, right?
That certainly is true. And quite frankly, we're going to see a trend here where a lot of landlords, a lot of tenants are going to want to start doing 1 year leases and 2 year leases instead of doing the 5 and 10 year leases. We're going to see a wave of that. And underwriters are going to have a problem with that. I say that we should keep in mind, we should get into the underwriter's chair for a moment and understand what the underwriter is faced with. The underwriter, when it's banks, the underwriter is lending money that's not theirs. It's depositors' money that they're lending. People's rent money, their grocery money, their babysitter payment money, stuff like that. So they got to be careful with that money, how it is they lend it. They got to be able to make sure they get that money back without having to go through the gymnastics of foreclosure and all that kind of hoop-de-doo. So they have to understand that burden on an underwriter, and then it's up to people like us who are loan originators to help them to deal with that, to help them somehow or another stay safe. So in a world where all of a sudden tenants and landlords are going to start doing 1 year leases, what's going to have to happen? Well, underwriters are going to have to find new ways of doing things, of underwriting and approving loans. Because guess what? Underwriters still have to lend money. That's how banks and non-bank lenders make money, is by lending it. Still have to find a way to lend it. We have to help them. So we have to get on their side of it, join the team, and not be in an opposite role here. We have to actually help them to do this and do this safely.
Wonderful. And thank you for that. And so interest rates have dropped dramatically, recently. And so a typical question that a buyer would have is, what are interest rates today? And I know there's a lot of, depends in there. But
I got the answer. Rates are great.
Rates are great.
That's all you have to say. Rates are great.
Oh.
You're gonna get what you deserve on a rate. If it's someone that's very strong, they're gonna get rates frankly in the 2s to 3s right now. And if it's someone that's not as strong and they're still getting either conventional or SBA financing, it may be pushing in the 5s. Obviously, Earl would know if you have to do bridge financing, you're still in the 8 to 12 range. But if someone can take advantage of the rates, they're amazing right now. They're not going to last, and that is going to curtail ability to purchase for both owner users as well as investor properties, maybe even more so for investor properties when they're looking at NOI, because that's already thrown off LTVs. But right now, as banks are pulling back, I'm literally as busy as I've ever been in my entire career right now. So it's definitely a good time and to make hay while the sun's shining.
What about Earl for investors, and what are rates looking like for investors?
Rates are really down. We have bond buyers to thank for that, and the Fed is a part of that. The Fed's been buying mortgage portfolios and everything, and that's part of the reason why rates are so far down. They seem to be committed to doing that for a while yet, in order to, as a part of the economy stimulus, to stimulate the economy. But as Greg said, that won't last forever. So certainly for somebody who's like really good borrower, good building, good this, good that, there's an awful lot of rates in the high 2s and to the high 3s. When we start having issues though with property and buyer quality, why those rates start going up in the 4s and 5s, and for regular amortized loans. And like Greg said, in private money now, starts going above that, and there's a lot of money in the 6s, 7s, 8s, 9s, 10s, sometimes higher depending upon what's going on. And I think that when the cheap money starts drying up, if that actually happens, why all of a sudden private money will get more and more popular, and we're going to be seeing more of that being used. So I just gotta, I just really have to caution investors: be liquid, keep your loan to values low, keep your properties maintained. Right now, Gary, you gave me a referral, so I appreciate very much. Going through property condition issues right now on that one, because we haven't seen a can of paint, a bucket of paint for the last 40 years or so, and it shows. So we're dealing with that. We need to have people keep their properties maintained, to make them have tenant appeal and investor appeal, so that a tenant drives by and says, "Oh, I'd like to live there one day. That looks nice." And an investor would like to say, "Oh, I'd like to own that one day. I hope it comes up for sale one day," and because it looks nice. And that's not happening right now. That's a problem right now across the market. But rates really are down right now for good properties with good, well-qualified borrowers. They certainly are.
And you mentioned loan to value ratios, keep them low. And so we do have a question here from Jacob. It says, how are we evaluating loan to value ratios in the area where valuations are very much in the air? We've seen all kinds of discounts that appraisers are putting on values of the property. So, what are some, as we're underwriting our own deals, what type of loan to value ratio should we be, looking at?
I think this is where people get very confused, especially buyers and commercial real estate brokers. Obviously, to be able to come in on SBA financing, you can get in with very high loan to value, up to 90%. But where I see the most, I don't know if I want to say ignorance, but it is in the investment side, because a bank's going to say we can do 75% loan to value, but most of the bankers don't know how to calculate NOI. So it's something that I always encourage people that are involved in CCIM, or at least attending meetings, do a couple of courses, learn how to do some basic calculations, because when you're looking in California, it's probably going to be 40 to 50% down on most investor transactions, just because where prices are and where rents are. And that might even become a little bit more difficult, as Earl had mentioned, because they're going to have shorter term leases, and maybe the underwriters aren't going to count those leases, or they're going to say, you know what, there's 3 years of lease. We might give you a 25-year AM, but we're only going to give you a 3-year term. So definitely learn how to do NOI calculations, because when a bank says they can do up to 75 or 70% loan to value on investor deals, they're probably only going to do 50 to 60% maximum. So it's something to keep in the back of your mind, especially when you're touring clients. Find out how much money they have to put down. And that's why, as Earl mentioned, looking at someone's schedule of real estate, when they have a lot of paid off properties that they can either utilize for cross collateralization or just show that they're disciplined investors, that's something that's going to be worthwhile to the lenders, whether they're a bank or a non-bank lender.
You know, I'll second that. Certainly, I've got multifamily lenders who will go up to 80% loan to value, but that's not going to happen in LA or Orange County. It just isn't, because the interplay between rents and property prices. You know, you take a 10-unit apartment building over in Long Beach, it's probably going to sell for $4.5–5 million, and the rents are only going to support a loan of probably about 45 or 50% or so. But you take the same building and you drive it up and you plop it in Lancaster, up there in the high desert, and all of a sudden that becomes a candidate for an 80% loan to value loan. You know, and I'd probably be able to do that. Or you take it up to Fresno or Central Valley or something like that. Yes, 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 yes. So it all has to do with the interplay between how much the rents are and how much the purchase price of the property is. When the cash flows are calculated, like Greg points out, the NOI calculated by a broker or by an investor is one figure, but the NOI, the net operating income calculated by a lender, is different. And it's different because the lender has to budget for reserves, for maintenance. And even if an investor is self-managing that property, a lender still has to budget for, in the event that something happens, that an off-site property manager has to be contracted for and used. Well, there we go, 4 or 5% of rents, and so we have to budget for stuff like that, as well as for a few other things that an investor is not going to do.
What about reserves? What typical like percentage should an investor use for reserves?
Well, here's an idea. You take an apartment building, and typically we have to set aside $300 to $350 per year just for regular maintenance and repair.
Right.
Plus, okay, another $100 per unit per year for paint and decorating. So that would be going around with a can of touch-up paint and touching up the trim. You know, $100 for that. Another $100 set aside for cleaning. So whenever a tenant moves out, there has to be cash in the kitty to go and make that unit rent ready again. So you got to paint it and shampoo the carpets or do whatever to the floors and this, that. That doesn't include changing the bathroom and kitchen fixtures and the floor material. No. That's just regular, scrubbing the walls and shampooing the carpets. $100 a unit for that, plus another $85 just for supplies, the stuff the owner buys from Home Depot, and then the reserves for eventual replacement of bathroom fixtures and kitchen fixtures, another $250 to $300 for that. Now, those figures get jimmied around a bit depending upon how recent the property was built and also what its physical condition is. If it's been run down, hasn't been maintained for a long time, those numbers will go up. Whereas if it's been really pristine conditions, those numbers will go down a bit. So we have to rely on the appraiser for some of that and the property inspection.
So I'm looking at the time here, and I can't believe we're already getting close to 1 o'clock. It seems like we just jumped on here, but just Daniel. I mean, all of you are really busy. Daniel, what's keeping you really busy these days? What are you working on? What's keeping you busy?
Definitely right now, purchases are always going to keep us busy. I mean, the purchase of owner-occupied buildings right now are still keeping us busy, but we've been seeing a lot of SBA 504 refinances, especially with our current SBA 504 effective rates, I mean, you can do a 25-year refi and you can have a 2.268% rate on the second trust deed with us. I mean, it's refinances are something that is really big right now, and even refinances with expansion, meaning that an owner user is going to refinance their current property and expand a little bit. Whether expansion can mean a lot of different things. Are going to be either expanding on the property that they own, or they possibly might be looking at creating more jobs within that business. It's something that we are extremely busy with right now and just answering questions, because at the same time, like we've all kind of business dating, there's a lot of private notes that are out there right now, and a lot of our owner users are looking to possibly move on from those private notes and to get into something that's a long-term loan, and with the rates that they are right now, I mean, having a fixed rate at 2.26%, it's unbelievable.
Yeah, it really is. Yeah, thank you for that, Greg. I assume you have similar stories as to what's keeping you busy, but is there any type of businesses you see right now that are not doing very well and maybe running behind on their payments?
Well, I mean, I haven't come across any on my own. Like I said, and in terms of perhaps medical offices that aren't aren't open, hopefully these doctors have some good reserves. Anything to do with the restaurant industry, yeah, some are opening up for takeout. They're putting some chairs on the patio, but I think that's still tough. What I am seeing a lot of, I'm seeing both conventional refinances, some SBA refinances, and then the businesses that are doing well and they need to expand and they need to buy properties, they're going to do it. They're going to do it now at 2% rates. They're going to do it at 15% rates. If it makes sense to buy, people are going to buy. So I have heard from a couple of people that work at some larger non-bank lenders, which is a little bit scary. They were following up on a lot of these businesses that were getting the PPP loans, and they said about 40% of the business they called were not in business anymore. So that's pretty scary. I don't know what businesses they were. They may, because they were going through, say, a non-bank lender, they may have not been the strongest businesses to get these financing. But that's obviously telling. It's the tip of the iceberg now. We don't know what companies are gonna be able to maintain through this once all the government aid stops. So it's good. I think it is wise that banks, lenders are looking at all of these with a little bit more scrutiny, and we'll see how we all fare through this.
Wonderful, thank you for that. And here's my final question. Just looking at the time here, we're pretty much out, but. Earl, tell us quickly, what's your ideal referral for you? When should we be calling you?
Well, thank you. Thank you for asking. My role here in the world, which you see behind me there, is to support commercial real estate brokers in their efforts to service clients by selling them properties, as well as helping them keep their existing portfolio healthy. So, I invite commercial real estate brokers and agents to call me as I can do things with finance to support their efforts to sell buildings and help their clients to keep their portfolios financed, because these loans have to be redone every several years. So and some clients are finding out that, oh my gosh, I did this with so-and-so bank before, but they're not offering me what they were before. I need somebody else. Do you know somebody?
Right.
That call, if it comes to me, I'll help them to fix it. So that's the call I'd like to receive.
Earl, wonderful, thank you. Daniel, what's the ideal referral for you? Yeah.
Ideal referral, I mean, for us, I mean, it's because we want to show support to both the third-party lender and to the borrower, and as well as the broker that we're working with on the deal. As soon as the project is right at inception, we want to be involved right away. We don't want to get in after the fact that possibly already, 25, 30 days into escrow, we're already, behind the eight ball. We want to be, we want to discuss it with the borrower because, as Greg mentioned earlier in the call, we are here to determine eligibility for SBA financing, and eligibility is the essential piece that we need to be able to accomplish and determine at the beginning of the loan cycle. So if we can't have the the loan eligible and we can't deem it eligible, the deal falls through right there, and we're just going to end up, you know, doing a disservice to the borrower and everybody that's involved in the transaction. So as soon as we can get involved right away, as soon as the project is brought up, we want to be involved right away to determine eligibility, and we just take it from that point.
Wonderful. Greg, when should we be calling you? What's the ideal referral for you?
Well, I obviously like to get in as early as possible, and it's on what my specialty is owner-occupied commercial real estate. So it's going to be someone that wants to take the route of an SBA loan if they want to go conventional. What I'm going to always do is I'm going to do that full field underwrite like I talked about. I'm going to ask the questions that maybe some people don't ask, and find out a very detailed on why this client is acquiring the building and what their goals are with their finances. And then it's going to be able to determine what route to take on their financing. This is going to be probably the largest financial decision of their life. Most of the time it's someone's home, but in the commercial real estate world, it's probably going to be their building. So I want to make sure that I'm doing the right thing. Sometimes I have to tell them that you know, they have a great offer with another bank, and I'm going to tell them to take that if they think that that's a valid offer. I'm here for the long run. I partner up with commercial real estate brokers most of the time on owner-occupied commercial real estate. A client is probably going to buy one building. They may buy two. So it's not multiple buildings. So even though they are the end user is my client, my real partners are the commercial real estate brokers, the mortgage brokers, the CDC reps. So anyone that I can do to help out and do a full underwrite for someone instead of waiting till it goes through and underwrite in a month or month and a half down the road, you get your answer, which may be a no. I can tell you up front if this is something that's going to be financeable or not.
Wonderful. Thank you, Greg. And so we're going to go ahead and wrap up now, but before we do, we want to make sure we answer all questions. Earl, I think this is a question for you. Diana Kaplan is asking, is a 3.85 rate with a 725 term for a corporate triple net leased single tenant retail building good?
Was that 3.75%?
3.85%.
Yeah, it sounds pretty good. Yeah, but we got to see the rest of what's going on to tell for sure. But offhand, that does sound okay.
Okay.
That was a single tenant, was it?
A single tenant, yeah, retail building. Yeah. And so maybe what Diana, if Earl could certainly answer some additional questions, and I think that Earl will be a good contact for that. But with that, wanted to thank our panelists here. Thank you so much for your time. I know each of you are extremely busy, and so want to make sure that we thank you very much for all the support you give our chapter. And so again, if anyone has any questions, our panelists, along with all our sponsors, are open for business, and they'd love to hear from you. So again, thank you everyone for participating. If you would like a recording, again, it's going to be on the YouTube, SoCal CCIM YouTube channel. And so if you just type that into Google, you should be able to find it. If you have any difficult times, email myself or our chapter administrator, and we'll go ahead and get everything over to you. So with that, again, thank you everyone for your time. Have a great day, and we will see you soon. Thank you.
Thank you, everybody.
Thank you.
Thank you, everybody.
Bye-bye.